You can make as much money when financial markets fall as when they rise. In fact, had you invested $100 in pound USD, you could have made $300 in less than 24 hours. How? Bearish chart patterns. And I'm going to break it down for you right now. My name is Mike, and I teach you how to trade right now. If you want to make money in the markets, stocks, currency pairs, and crypto, you come to the right place. Inherently, we understand that if we buy low and sell high, we make money. I buy Sixers tickets for $50, and I sell them to you for $200. I just made $150. Markets move in the same way. If you buy or go long, you expect financial markets to increase over time. The goal is to sell Apple at a higher price than what you purchased it, thereby making a profit. It's a little confusing, but you can make money when markets fall. It's called short selling. To execute a short sale, a trader first borrows shares of Apple from a broker. The broker lends the shares to the trader with the understanding that they will be returned at a later date. After obtaining the borrowed shares, the trader immediately sells them on the open market. This creates a short position because the trader has sold shares he doesn't own. He hopes that the price of the stock will decline by the time the borrowed shares have to be returned. If the price falls, he can buy the shares back at the lower price. To close his short position, a trader must buy back the same number of shares he initially borrowed. This process is known as covering the short position. The trader returns the borrowed shares to the broker. If he buys the shares back at a lower price than what they were sold, he makes a profit. If the price increases, he incurs a loss. Still confused? Here's a simplified example. You borrow 100 shares of Disney and sell them for $50 each, receiving $5,000. The stock price falls to $40. You buy back the 100 shares of Disney for $40 per share or $4,000. You return the borrowed shares to your broker. You just made $1,000 or $5,000 from selling the Disney shares minus $4,000 from buying them back. In short, you take a short position when you anticipate price falling. You sell high and buy low. Price is low because the markets have entered a downtrend. In a downtrend, price consistently forms lower highs and lower lows. The primary characteristic of a bear market is a sustained decline in price. This drop is often fueled by negative sentiment, economic concerns, or a combination of factors that erode investor confidence. You can use price declines, moving averages, and economic indicators to identify bearish sentiment. You can also use chart patterns. Bearish chart patterns can provide visual clues of a potential trend reversal or the onset of a bear market. I have 5 favorite bearish chart patterns: the double top, head and shoulders, descending triangle, rising wedge, and bearish flag. Let's break down each one by one. The first pattern that we're going to explore is the double top. The double top is a bearish reversal pattern that occurs after an uptrend and signals a potential trend reversal to the downside. This pattern is characterized by 2 distinct peaks or tops at approximately the same price level, separated by a trough in between, which creates a neckline. The double top looks like the letter M and typically forms after a prolonged uptrend. Traders are optimistic, but the chart formation signals pessimism. Let's see what I mean on the Apple chart 15-minute frequency. The first step in identifying the double top is the formation of the first peak, which occurs when price reaches a high point, forming the first top. As price reverses, it looks like buyers are losing control. After the first peak, sellers cause the price to fall until it reaches a trough. Eventually, the reversal bottoms out. Following the trough, the price rises again, forming a second peak. The second top should be at approximately the same price level as the first top, creating a horizontal resistance level. Resistance is the price where demand is less than supply. There are fewer buyers than sellers, and because of this, price goes down. If you want to learn more about support and resistance levels, check out the video link in the description below. As price bounces off of the resistance level for the second time, the bearish reversal is confirmed when price breaks below the neckline formed between the 2 peaks. This breakout signals a shift in market sentiment from bullish to bearish. We enter after the breakout, setting our stop loss outside both peaks. Our take profit is the next key support and resistance zone, which is typically where the former uptrend began. As candles close, we see the shift towards a downtrend, we're rewarded with a 1.4 to 1 risk reward ratio, or we made $140 for every $100 we invested. The head and shoulders chart pattern is a bearish reversal pattern that shares similarities with a double top. However, instead of 2 peaks, the head and shoulders consists of 3 peaks, and one of those peaks does not match the same price level as the other 2. Like the double top, the head and shoulders signals a potential trend reversal from an uptrend to a downtrend. The head and shoulders typically forms after a prolonged uptrend, signaling that buyers are in control. The pattern consists of 3 peaks, with the middle peak rising higher than the other 2, forming a shape resembling one head and 2 shoulders. The pattern begins with an upward price movement, forming a left shoulder. Price reverses as sellers appear to be in control. The pullback or retracement forms a trough. The trough is a beginning of a neckline at support. Support is the price where demand is greater than supply. There are more buyers than sellers, and because of this, price goes up. What follows is strong upward movement that pushes price beyond the shoulder to form a higher high. This peak is called the head and represents the highest point in the pattern. Sellers regain control, at least temporarily. After the head, there's another pullback in price to support. The right shoulder forms when buyers fight back, forming a third peak that is lower than the head, but typically higher than the left shoulder. Traders will wait for a confirmed break below the neckline to signal a completed head and shoulder pattern. This break below the neckline indicates a likely trend reversal to the downside. After the third attempt to break past support, sellers are finally in control. The bearish reversal is confirmed after price breaks below the support level formed by the trough between the peaks. This breakout signals a shift in market sentiment from bullish to bearish. Once again, we enter after the candles close below the neckline. This time I set my stop loss slightly above the right shoulder, and my take profit target is the next key level of support and resistance. The candles close and we achieve a higher risk reward ratio of 2 to 1, or we made $200 for every $100 we invested. The double top and head and shoulders pattern rely on similar shapes to signify buyers have lost control. The descending triangle is another formation that reveals bears are back in control. Let's dive deeper. I want to let you in on a secret. The more likes this video gets, the more free content I can create for you. Please take a second to like and subscribe below. I appreciate you. Now let's get back to business. The descending triangle is a bearish continuation pattern that is used by traders to identify periods of potential downtrend price movement. This pattern forms during a downtrend and consists of 2 main components, a horizontal support line and a descending trend line. The descending triangle is formed when price creates a series of lower highs, indicating a downtrend. At the same time, there is a horizontal support level where price struggles to break through. Remember, support is a price level where the market tends to reverse to the upside after a bearish move. Resistance, on the other hand, is a price level where the market tends to reverse down after a bullish move. Here, the horizontal support level represents a price point where buyers have historically prevented sellers from pushing the price lower, but not for nothing. The descending trend line represents lower highs and shows that sellers are willing to step in slowly and methodically, pushing the price lower. As the price moves between descending resistance and horizontal support, the range between the two narrows. The bearish breakout occurs when price successfully moves below the horizontal support level. We enter short after the breakout. Our stop loss is placed at or above support, turn resistance. Our take profit target is a key level of support and resistance. The candles close, and within 1 hour, we've achieved a 2 to 1 risk reward ratio. We made $200 for every $100 we invested. What's cool about the descending triangle is you can watch the lower highs form, one after the other. The trend line gradually descends, forecasting the drop in price. Ascending patterns can forecast bearish sentiment too. Let me explain. The ascending wedge is a bearish continuation pattern that forms after a downtrend but looks like an uptrend. It's characterized by converging trend lines where both support and resistance slope upward. Price is consolidating temporarily. Consolidation is generally looked upon as market indecisiveness. Price is moving between 2 ranges for an extended period of time. In our case, the consolidation forms a wedge-like pattern where the upper trend line is steeper than the lower trend line as price makes higher highs and higher lows. The upper trend line represents resistance while the lower trend line acts as support. Both trend lines slope upwards, indicating a narrowing range of price movement, i.e. consolidation. Trading volume is declining, suggesting a potential decrease in selling pressure. The bulls are weakening and the bears, they're regaining control. The bearish breakout occurs when the price breaks below the lower trend line. This breakout is typically accompanied by an increase in trading volume, confirming the downtrend continuation, brought to you by sellers back in control. We enter after the breakout, setting our stop loss slightly above support or our upper trend line. Our take profit target is a key level of support and resistance. It takes a few hours and we exit the trade profitably, risking $100 to make $300 or a risk reward ratio of 3-to-1. Our fifth and final bearish chart pattern is named after its appearance. The bearish flag pattern is a continuation pattern that signals a brief consolidation in an existing downtrend before the downtrend continues. It's formed during a strong downward price movement known as the flagpole, followed by a rectangular shaped consolidation, which is the flag. The flagpole is a sharp, nearly vertical downward move in price representing strong seller power. The flag is a rectangular consolidation that slopes against the prevailing trend. It usually occurs with lower trading volume, indicating a pause in market activity. The lower boundary of the flag is support, which we draw by connecting the lows. The upper boundary, acting as resistance, is drawn in parallel to support by connecting the highs. As always, we enter after the breakout. The bearish breakout occurs when price breaks below support, signaling that sellers are back in control. We enter short. Our stop loss is placed outside of resistance above the upper boundary of the flag. Our take profit target is based on the height of the flagpole, projecting that distance downward from the breakout point. 24 hours later, we made $300 for every $100 we risked, achieving a 3-to-1 risk reward ratio. No pattern is right 100% of the time. Your best bet is to always put proper risk management in place, including limiting losses by using a stop loss. Regularly review what works and what does not. By doing so, you'll discover profitable patterns in your approach. Speaking of which, bearish chart patterns can signal when it's time to short. When price breaks down, you stand to profit if you can follow the visual clues that say sellers are in control. If you found this information helpful, all I ask is that you like this video and subscribe to the channel. It takes 2 seconds and 2 clicks, and it means so much to me. Remember to check out my other videos, and thanks for watching.